Good morning, everyone. Selamat pagi, Malaysia. Ciao an, kalai vanakkam. Ohayou gozaimasu. I hope everyone is doing having a great day today. Thank you for joining us on Saturday morning on this special Borak session with Maybank Live. My name is Naguib Hussin, and with us today we have Anand Pathmakantan, Head of Equity Research, who will share with us his Malaysia equity strategy for the second half of this year. Hi, Anand. Morning. You got your coffee ready? Hi.
Yeah, I got my green tea all set.
Okay, great. Okay, before we begin the session, let me start with some disclaimers. All the information shared during this webinar is based on published reports by Maybank Investment Bank and does not constitute an offer to buy or sell securities. Okay, ladies and gentlemen, our audience, thank you for, again, dialing on to this very meaningful Saturday morning. So despite a slow start to the first half, I'm very excited as we're starting to see positive recovery not only on Bersama Malaysia, but also on the global markets as well. Now, Anand, I think the investors who have joined us here this Saturday morning would like to get your thoughts on the market, sectors, as well as some of the stock picks which they can benefit from. And clearly what you're going to go through today will be basically covering your recent second half Malaysia strategy report, which was published a few weeks ago. Okay, going to the second half of the year, where do you see the key drivers to look out for the market? I think that's very important. Let's see where you think that we will land at the end of the year. I guess apart from your KLCI index targets and what are the key drivers that investors should be looking at in order to benefit from it.
Sure. So I'll give you a lot of downbeat news for the first half, as reflected by the market performance. But we are, as per the title of our presentation, Clearer Skies Ahead, we are quite constructive and positive on the second half market performance. And, that's being borne out really in the last couple of weeks, where the Malaysian market has joined its regional counterparts in showing a initial re-rating. And we expect that kind of re-rating momentum to continue slowly but surely through to the end of the year. So we're looking at a 1520 KLCI target by the end of the year. It was about 9% upside when we wrote our report. It's about 5% now. So a couple of things that will support this re-rating. One is the inflation interest rate picture is much more positive now, right? After the US CPI data, there was overnight data as well on lead indicators for CPI, which were very favorable to a soft landing for the US. The dynamics have changed a lot. Inflation numbers are coming in below expectation. We do expect rates to peak in the US, if not already, by the fourth quarter of this year, with a definitely final 25 basis points Fed rate hike. And then next year, we will be looking forward to a lot of cuts. And at the same time, the weaker US dollar stemming from that revised interest rate outlook will be very supportive of emerging market currencies and commodity prices, which many emerging markets like Malaysia and Indonesia are positively leveraged into. A couple other things. China, we've had a lot of negative news flow in the first half. We think news flow will start to stabilize in the second half, potentially with more stimulus by the Chinese government. And that'll be good for Malaysia and ASEAN, but particularly for Malaysia, because the Malaysian ringgit actually is the most closely correlated currency to the yuan compared to our ASEAN neighbors. The correlation is about 0.8 based on our FX team. So if the yuan starts to strengthen, that will provide some support for the ringgit as well, and of course, ringgit assets. We also have to understand where we're starting from, right? In terms of this re-rating, we're starting from a very low base. Even after revising our earnings down, the KLCI is only trading on 12 times forward PER. This is -2 standard deviations below its mean of 16 times. Yeah, so we're very, very far away from where the KLCI historically trades. Yeah, so in terms of making up some of that room at least, it shouldn't be too challenging, even if earnings are proving to be a bit more mixed. I think some of the thematics we think will support the market as well. One very important one, which the government always flags, and which is definitely happening, is supply chain relocation and capex revival. Sounds like a catch-all, but actually it's two separate things. Yeah, capex revival includes domestic direct investment. So I think if you read the MADANI economy text, there was a reiteration that a lot of domestic-centric projects of very high value add would go ahead. MRT3, Penang LRT, Johor Bahru Bus Rapid Transit, the Penang and Subang airport extensions. These are all very stimulative, high multiplier projects, which will stimulate domestic direct investment. At the same time, you have supply chain relocation, which is a regional thematic. This is the China plus one strategy that many MNCs are pursuing. And our FDI numbers are at record levels for the last 2 years. So that is happening. It may take some time to play out, but definitely it'll be very, impactful for the economy as well as the market. Inflation interest rates, I mentioned, quite supportive now. Dividend yield is a big attraction for Malaysia at this point. Because of depressed valuations and, most Malaysian corporates don't have a balance sheet issue. Their cash flows are actually quite strong, quite stable. And two other things I'll mention in passing. Sustainability. This is tied to the National Energy Transition Roadmap that was announced yesterday, as well as GLC reform, which is something Malaysia has done before. And hopefully we can fine-tune that going forward to create more value. This could be supportive as well.
All right. Okay. That's a lot to unpack. I guess, basically to sum things up, I guess it's, again, CAPEX revival, inflation and interest rates, GLC reform, as you mentioned, dividend yield, as well as ESG. I'm very much into the dividend yield story. I think there's a lot of value there. Cash are high, and clearly corporates are paying out, as well as the ESG. We put up the NETR. The conversations right now in all the kopitiams is that how much are they going to get for the rental of their roofs in order to contribute to the grid. But I guess that will be a work in progress. I think there'll be more of a discussion. And I think to the audience, these are the thematic plays to look out for Bursa in the second half of this year. Okay, I think we have to dive in a little bit into the sectors, Anand, so that investors have a feel to what sectors that you think that we should be overweight, and also selective, as well as some of your top stocks that you like, and I guess you would probably say you can avoid.
Sure. So this pictorial gives you sort of an overview of the sectors we like, where we're selective. This is by no means all the sectors we cover. We also cover stuff like plantations, renewables, which are not in this graphic. So I think for overweight, banks, definitely something we like a lot. It ticks a lot of boxes for us, in terms of valuations, in terms of yield. The average yield for the banking sector now is above 5.5%. This is very attractive. And also earnings. So net interest margins, banks are one of the beneficiaries of rising rates. In fact, they are the main beneficiary of all the sectors we cover from rising rates. And that's been reflected in their margin improvement. There was a bit of, banks did correct a bit in the first half because of concerns about, margin upside being quite limited by deposit competition. But we feel that's overblown. Based on our channel checks, deposit competition has eased, deposit rates have eased. So we should see a resumption in NIM strength into the second half. And at the same time, credit costs have been very well behaved. So for all those reasons, we do like the banks. Tech is also top of the mind for investors. It's been one of the best secular growth story for Malaysian equities for a long time. But here we're a bit differentiated from our competitors. We are saying take some money off the table for tech hardware and relook at tech software and EMS. EMS is electronic manufacturing services. So those two subsectors we prefer to hardware. Hardware, as I mentioned before, the semiconductor cycle is quite negative right now. There's a lot of oversupply, a lot of demand uncertainty as economies have slowed. And that's being reflected in the tech hardware results we're seeing. We had Globetronics report a few days ago. We had Vitrox report yesterday. Quite unexciting results and outlook. And we think that will continue for the tech hardware space into early next year. So we only have one pick in tech hardware, and that's Great Tech. And that's because of its exposure to EV and solar, which are secular growth stories, unaffected by the semiconductor slowdown. Tech software, we like stocks like CTOS, dominant position in credit data in Malaysia, and the numbers are good. Results were out just 2 days ago. Very good PBT numbers. Also, something like IT Max. I think it's a smaller company, but a lot of growth potential in smart city solutions. And also in the EMS space, something like Aurelius Technologies has done very well for us, and we continue to like it. Quickly on the other sectors, auto sales numbers are still good. I know everyone's excited about Tesla coming to Malaysia, and disrupting the entire auto sector. I don't know, Najib, I don't know if you put in your order for a Tesla.
I'm not sure. I think the media is showing about Dolphin from BYD for 99,000 ringgit.
Correct.
And that is another company which is related to Sime Holdings as well. So, I mean, we'll wait for the outcome, but I guess it's a great time for Malaysian consumers to look into the EV space. And I guess the cliche is their spot for choice at this current moment.
Correct. Yeah. So, a lot of people are concerned about the knock-on impact on existing players from Tesla entering Malaysia. I think it's definitely overblown. And at $200,000 a car, some of us may think that's reasonable, but really it's still a very niche product in the car space. So we still like a stock like Burma's Auto, where Mazda is a very strong franchise. And we really like management's ability or potential to turn around their other franchises like Kia and Peugeot. Oil and gas, Brent has come back a bit. In the last month, it's gone up by about $10 per barrel. So I think oil names are worth keeping an eye on. These are stocks like Dialog, Yinson, Hibiscus. These are all on our buy list. Construction, Gamuda has been one of our best calls in the last 6-7 months. And that really shows you, when a company is able to demonstrate it can survive and thrive outside of the Malaysian ecosystem, they get rewarded, not just by re-rating, but by lots of foreign buying as well. Gamuda is one of those few stocks which has seen a big increase in foreign shareholding over the last half a year. So Gamuda remains our top pick there. Selective. Aviation is selective because when we did this, we hadn't published our AAX report yet. I'm sure a lot of you have seen our AAX report, which came out 2 days ago. Hard to miss because the share price went up 40% after the report came out. It's an excellent report. I definitely urge you to read it. But aviation is definitely a bright spot in the earnings picture. So perfect storm. You have very tight supply, you have very high airfares, you have jet fuel prices in US dollars coming down. And if the ringgit strengthens further, effective jet fuel costs will come down further. So that's very, very positive for earnings for such a high operating leverage business like aviation. Consumer, we prefer the down trading names like Mr. DIY and MADANI due to the difficult economy, and healthcare and utilities, which are more defensive. And I also like the MADANI concept because it doesn't just talk about growth, but it also talks about income distribution. And frankly, we all know wages in Malaysia are quite suppressed for a variety of reasons. Having a more equitable sort of income distribution for workers and wages in particular is beneficial to everyone. That's what a healthy economy is based on, because then you have a much more consumption-driven economy. Yeah, and you're much less reliant on trade or external drivers. You have an internal engine. That's what makes countries like Indonesia and Philippines so attractive for foreign investors, because there's a big consumption story. We can generate that consumption story in Malaysia if there's a more sort of equal distribution of returns between capital and labor. And I think the government has got that right in terms of focusing on fixing that. So yeah, overall, I really do look forward to the operationalization of the framework, and hopefully we can reach that 5.5 to 6% GDP target that the MADANI framework is targeting.
So that's all the time we have here today. As I mentioned again, you can get the latest market news as well as research from our social media channels. Our content is available on Telegram, LinkedIn, and YouTube. Alternatively, if you're interested to find out how you can trade with Maybank, you can reach out to our sales representative, or apply for an account via Maybank to you using the QR code on the screen. I think that'll be shown later. We are, accessible as well on Maybank to you. If you've enjoyed today's webinar, do consider subscribing to our social media channels and give us a like. Myself and Anand is also on LinkedIn. Feel free to reach out. On behalf of Maybank Investment Bank, this is Naguib, Hussin, and Anand Pathmakantan, thanking you for joining us on this Saturday morning. Thanks, everyone.
Do 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 do.